All right, today we're putting Livingstone Health on the examination table for a full financial checkup. We're going to dive deep into their latest half-year report and get a real sense of the company's health. You know, Livingstone operates right in the middle of the very competitive Singaporean healthcare scene, doing everything from family medicine to specialized procedures, so their performance is a pretty interesting signal for the whole sector. Okay, let's get into it. So here's our game plan. We'll start with a quick overview. Then we'll look at the good news, their really strong revenue growth. After that, we're going to turn into financial detectives and solve a bit of a mystery around their profits. Then we'll check their vital signs by looking at the balance sheet. And finally, we'll see what prescription the company has written for its own future growth.
First things first, the initial consultation. Before we start zooming in on any one number, we've got to get the lay of the land. These half-year reports are super important for anyone watching a company because they tell you if things are on track or if some new challenges have popped up.
And really, this is the big question, isn't it? Figuring out how healthy a healthcare company is, it's kind of unique. You're not just looking at the balance sheet. You're looking at their ability to grow, to invest in talent, and to handle the super high costs that come with medicine. So, is Livingstone Health in good shape, or are there some underlying issues we need to dig into?
Just so we're all on the same page, everything we're talking about today comes from this specific 6-month window. This is the evidence we're working with. It gives us a really fresh snapshot of the business and how their strategies are playing out in the real world right now.
Let's move on to the first big diagnostic test. When you're looking at a company's health, the very first thing you check is its pulse, its lifeblood, and in business, that's revenue. It tells you if the company is actually growing. And for Livingstone, the news here isn't just good, it's a sign of a very strong pulse. And here's the headline number, a really solid 10.2% jump in revenue compared to this time last year. Honestly, getting double-digit growth in any environment is pretty impressive, especially in a mature market like healthcare. It's a powerful signal that they're doing something right.
So to put some real dollars behind that percentage, revenue climbed from $13.5 million to almost 15 million Singapore dollars. That's an extra $1.3 million coming in the door. And remember, that's not just a number. It represents more patient visits, more procedures, and more demand for what they do.
Now, here's where it gets really interesting. This growth isn't just coming from one single area, it's happening across the board, which is a sign of a really healthy business. Their biggest segment, specialist healthcare, is up over 10%. Primary healthcare, you can think of that as your family doctor services, is up a steady 7.9%. And their others group, which includes things like aesthetics, saw the biggest leap of all at over 14%. This company is firing on all cylinders when it comes to bringing in business.
Okay, so with revenue looking that good, you'd think the rest of the story would be just as positive. More sales should mean more profit, right? That's Business 101. Well, this is where our checkup reveals something unexpected, a symptom that we need to investigate. We're about to go from a simple story of growth to a real financial puzzle.
And here is the whole mystery laid out for us. While revenue was surging up by over 10%, profit cratered. It fell by a staggering 56.3%. This is a huge disconnect. How on earth do you bring in way more money but end up with way less in your pocket? It's the one question we have to answer. So what's going on here? How does this happen? Well, our job now is to follow the money. We've seen what's coming in. Now we need to figure out what's going out. We have to dig into the expenses. The report points us to three main culprits. First, the cost of medical supplies and consumables shot up by 16%. That's a big deal because it's growing way faster than revenue. Second, employee expenses also grew faster than revenue, up almost 11%. And third, something called other operating income dropped by over 45%. So when you put it all together, the profit squeeze was caused by a kind of perfect storm. The cost of just doing business, things like gloves, syringes, all that stuff, went up. At the same time, they made a strategic call to hire more people and invest in their team. And the cherry on top, other income, which probably included some government pandemic grants last year, was much, much lower this year. It's a mix of outside pressures and inside decisions. All right, let's move on. We've looked at the income statement. That's like a video of the company's performance over 6 months. Now we need to look at the balance sheet, which is more like a photograph, a snapshot of the company's health on one single day. It tells us what they own and what they owe. So first up, what does Livingstone Health own? About $18.2 million in total assets, and it's split pretty evenly. About 55% is what we call current assets. That's cash and stuff that can be turned into cash pretty quickly.
The other 45% is non-current assets, the long-term stuff, like their clinics and all that expensive medical gear. It's a pretty healthy balance.
And now for the other side of the coin, what they owe. About $13.1 million in liabilities, but look at the split here. This is important. A whopping 74% are current liabilities, meaning bills and debts that are due within the next year. This is a key insight. It means the company has a lot of short-term bills to juggle, which puts pressure on their day-to-day cash. They have to be really sharp with their financial management.
Okay, so let's recap the diagnosis. We've got a patient with a strong heartbeat. That's the awesome revenue growth. But they're also running a bit of a fever, with rising costs eating away at profits. And their blood pressure, those short-term debts, is a little on the high side. So what's the treatment plan? Let's see what prescription the company has for its own future.
They've laid out a really clear three-part strategy. First, they're going to keep expanding their team. This links right back to those higher employee costs we saw. It's a deliberate investment. Second, they're actively hunting for smart acquisitions, especially in primary care. And third, they're investing in data and tech. This is their plan to get more efficient, the medicine to treat that cost fever.
Of course, a strategy is just a dream without the cash to back it up. And Livingstone has gone out and secured it. They've lined up $7 million in new loan facilities from a few different banks. That is some serious fuel for their growth engine.
And here's the crucial part. This money is just sitting there, ready to go. Think of it like a war chest. It gives them a ton of flexibility. If the right company comes along to buy, they can pounce. And it's also a safety net for managing those short-term bills we talked about. It's a very smart move.
And this quote, straight from their report, says it all. Listen to the words: streamline, optimize, enhance. This is a direct message to anyone watching. It shows they know all about those cost pressures we found. They're basically saying, yes, we're spending money to grow, but we're also laser-focused on making the business more efficient.
Which brings us right to our final big question. Livingstone Health is essentially spending money to solve a profit problem. They're investing in growth, in people, in technology, all for what they hope is a much healthier and more profitable company down the road. The diagnosis is clear, the treatment has begun. But the question is, will the medicine work? For that answer, we'll just have to wait for the next financial report.